Well, hey there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, November 5th, 2025. I'm your host, Dave Keller. Great to be with you here today and every weekday after the close for our show. It is a beautiful fall day here in Redmond, Washington. Overcast, little rain this morning, lightening up this afternoon. Lots to be thankful for. And I'm thankful to be sharing some charts and observations and ideas with all of you here today. We've been tracking this choppy beginning to the month of November. Yesterday, a bit of a risk-off move as the market finished near the lows of the day. Big sell-off day for the NASDAQ, down over 2%. Today, nice recovery. However, the last, we'll call it 40 minutes of trading accelerated to the downside. So the S&P and the NASDAQ and even the Dow did finish in the green, but it was a lot greener with the S&P around 68.30. After lunch, Eastern time, by the close, we had dipped just below 6,800. So still a good positive day in terms of trend, not nearly as strong of a positive day in terms of what the sentiment during the day sort of suggested. We've had a couple of those big distribution moves in the last hour of trading. Last 30 minutes, last 45 minutes of trading, usually mostly institutions, rotating some larger volumes. They'll wait to the end of the day to lighten up, try to minimize impact on the market. Also can be ETF rebalancing and other things like that. But nothing about a big acceleration into the close is usually a very good sign for what it's worth. Again, we're still holding our ground, so let's be thankful for that. But let's also focus on the charts here. We'll do a brief recap of what moved today, what happened, and things that I think you should be aware of. We'll then pivot and look at the heat map, talk about some sector styles and movements at the individual stock level. Then we'll finish off looking at some charts together. As I'm sure you've picked up on if you've watched the show before, my background is in technical analysis and behavioral finance. Behavioral finance is what happens between our ears, how we think, why we are wired to make poor decisions, and technical analysis, which is I see as a practical set of tools and techniques to help us minimize behavioral biases, get out of our own way, and hopefully make more effective, more consistent decisions with our portfolio. So here's what happened on the S&P. Here was yesterday's sort of distribution day with the sell-off through the course of the day. Today, a pretty decent up move until about 1:30 Eastern time, but the last 2.5 hours were weak, particularly the last half hour, where we literally accelerated into the close. I often use the analogy of whatever sport you follow, whether it's football, American football, any time where there's a halftime. And sometimes in the first half, your team just does not look good. The players are not playing particularly well. The team is not clicking. Passing, whatever it is, just is not going well. And you think, this team just needs to get off the field, get into a locker room somewhere, kind of take a deep breath, reset, get yelled at, get encouraged, whatever it is, and then get back on the field and have a very different second half. And that's what it felt like going into the close. Like we just needed the day to be over so the market could stop, or we reset, and maybe we are stronger for it the next session. As I mentioned, the S&P did finish below 6,800, 67.96 and change. That's up about 0.4%. From yesterday. The Dow slightly better, up 0.5%. The NASDAQ, the best of the three, up about 2/3%. But look at the move in small caps. So small caps had a nice rally through the course of the day. Sold off a little bit at the end of the day, but not nearly as much as the S&P. And so finished up 1.8%, which is kind of interesting because we've seen higher interest rates and higher interest rates don't tend to be good for small caps, right? I mean, they don't tend to be good for smaller companies that are looking to borrow money to grow, which is how most small cap companies are more likely to be in that kind of phase, right? The early growth phase where they need a lot of capital to be able to grow. And so small caps actually doing quite well here today, going into the close, outperforming the S&P 500. The VIX did move about a full percent lower, or full point lower, that is. We finished yesterday around 19. We finished today around 18. And it was down nearing about 17.25 around 3 p.m. Eastern. It did pop up pretty good as the market sold off into the close. So the fear gauge was definitely flashing, signaling some lack of optimism going into in today's close here. Rates generally moved higher. This is a familiar pattern we've been observing here. The short end of the curve, which is basically where the Fed is changing their target rate, has been drifting lower in line with the Fed's most recent meeting last week, where they outlined their plans or formalized a 25 basis point cut and speculated or certainly implied another rate cut at the December meeting. And then I think the real open question will be what happens at the beginning of 2026. But the longer end of the curve, the 10-year, the 30-year point, even the 5-year point have generally been trending higher. The 10-year point's currently around 4.16. That's 4.16%. The long bond yield's around 4.75. The 5-year point around 3.77. The dollar, not much of a change today, to be honest with you. It chopped around a little bit. So dollar flat, stocks up, although down into the close, and bonds generally lower here today. Looking at the commodity space, gold and silver having a pretty good up day. Earlier this week, gold sold off, has been chopping around that 21-day EMA. Today, the GLD was up about 1.2%, silver up 2.1%, copper up 1.2%, sort of the metals area of the commodity space pretty good. The energy side, not so good. Crude oil prices lower. The USO was down about 1.25%. Great to see Bitcoin and other cryptocurrencies recovering. Bitcoin did get down to 99,000 over the last 24 hours, but through the equity session, actually had a pretty decent upward move. Got us high of around 104,500 before the sell-off in equities. We're currently down a bit off of that. But still, nice recovery off of those lows. Big round numbers like 100,000. If you look back at the history of Bitcoin, it's actually rare for the market not to turn at one of those major sort of 10,000 increment spots. 20,000 was an important level, 30,000, 40,000, 50,000. I don't have to go through all of them. Just trust me, look back at the chart and you'll see it. And 100,000 has been an important one. So I don't think it's a coincidence that we get down to just below 100,000 and magically there's a ton of buying that kicks in. I would imagine, some bots somewhere are saying, hey, when Bitcoin gets down to 100,000, that's around 25%, 22% off of the all-time high. Let's pick up some Bitcoin, and that's what is happening here. All 10 of the top coins on the in the crypto space in the green today, all were down pretty significantly, so still underwater, but improving. On the sector side, not a bad day. You're going to see that measures of breadth, and in this case, sector breadth, pretty encouraging. That's not been the case recently. The last couple of weeks, we've had very negative breadth conditions, which we've covered, I think, pretty exhaustively on the show. Today, a nice reversal to that, sort of a nice up day in terms of measures of breadth. Here we can see that 9 of the 11 S&P sectors were up today. Consumer discretionary, the XLY, was the top performer, up 1.25%. Materials and communication services both up about 0.5%. On the downside, utilities and real estate were basically flat, and consumer staples not much worse. So again, everything was sort of flat to up today. Kind of a nice recovery day after yesterday. In terms of breadth, pretty good, and we haven't had pretty good breadth in a while. I can't remember the last session where we actually had decent breadth numbers, but about a 2-to-1 ratio. On the New York Composite Index, about the same for the S&P 500. For the small cap index, about a 4-to-1 ratio, a 3-to-1 ratio, advancers to decliners. So here we have 66% of the New York Stock Exchange members up, 31% down. That's good. Usually it's been basically flipped for quite some time. The growth leadership names that have been struggling, along with other things recently, having a nice recovery as well. Tesla, which arguably is still, one of the top 2 or 3 charts in this bucket, up another 4% today. Nice continuation of that uptrend. Alphabet pressing new all-time highs, up 2.4%. Broadcom and a bunch of other semiconductors had a pretty decent day here as well. NVIDIA, however, was not one of them. I'll show you. I forget which semiconductor I grabbed. I think I grabbed Micron, but if you look at like KLAC and M-Power and some of those other semiconductor names, LRCX, pretty good up days today, in some cases in a big way. But NVIDIA, the downside outlier, down 1.8%. Microsoft down 1.4%. Apple flat, pretty similar to yesterday's close. All right, shall we look at the heat map? As a reminder, one of the great joys of doing what I do and sharing charts with you all every day is I get your questions, and I appreciate them very much. please take a moment if what I'm showing you here, if I'm talking about elicits some question about a particular chart, about a particular technical indicator, about some macro theme, something about behavioral finance and biases that you've been struggling with. Nothing is out of bounds. And I appreciate your questions. Our YouTube channel, just drop a comment below with the question that you have. That's the best way to get them in front of me. And we are planning an all mailbag episode on Friday, November 7th. So we'd love to answer one of your questions there. All right, looking at the heat map here. So what stands out to me, I'll just go quickly through a couple of things here. So, I mean, number one, very much a mixed day. If you look across the heat map, some things up and certainly concentrated in technology, consumer discretionary, communication services. These are your three big growth sectors here. A lot of green, particularly in some of the larger names in these two sectors. Tesla, Alphabet, all having pretty good days today. In the upper left, it's worth noting to me that out of the top 5 largest weights in the XLK, NVIDIA and Microsoft both actually had pretty good down days. And stock number 6, Palantir, also down. Broadcom and Oracle and Apple actually positive today. But I think the real story in technology is all the other stuff, right? We saw a lot of red yesterday with semiconductors selling off pretty good. We talked about how the overall trends in those charts were generally still quite positive. A lot of these are still recently off of new all-time highs. And sure enough, charts like LRCX bounced back up to make a new all-time high, as did Micron, as did Applied Materials, KLAC not quite there, but getting there. So a number of names, even First Solar making new all-time highs today. So a number of things actually bouncing beautifully after yesterday's drop. I think still an open question as to whether we're in a painful corrective period, but for now, a nice upside reaction after what happened yesterday. Also want to note Western Digital up over 5%, Seagate STX up over 10%. Both of those names have made new all-time highs. We've been highlighting that group, what I call like the hard drive manufacturers, doing pretty well there. Over here, CAT is actually bouncing today up 4%. That's one of those charts that, I mean, for now, I think is showing a brief pullback within a nice long-term uptrend. We keep making higher highs and higher lows. So don't be afraid about charts like Caterpillar or others that pull back, right? In any healthy uptrend phase, you're going to have pullbacks. The question, and I think the challenge for investors, is how you differentiate a brief, very viable pullback to a more significant, avoidable and red flag kind of pullback, right? Something that breaks key support levels, and that's what we try to highlight. That's why we use certain things like the 21-day EMA as an initial sign of weakness, because if we can hold that on a pullback, there's just not much to be worried about. And so I would remind you with some of those names, don't be afraid to use some really basic but powerful and consistent trend following devices to make sure that you lock in and don't get scared out of something just because of one big down day. Now, outside of those things that I just mentioned, very mixed, right? And you can see within healthcare, some up, some down, a lot in the middle. In industrials, kind of a Christmas themed quilt with neutral amber in there, right? A lot of red, a lot of green. And I think that's the story for most of the 11 S&P sector. So the breadth technically positive. I would say there's still a number of stocks that were not up today. But again, a nice recovery day after yesterday, which felt like a pretty significant downdraft for stocks. All right, we're going to get to some charts here in a moment, but I do want to remind you we have our next live Q&A coming up tomorrow. I appreciate you guys hanging with me as I randomly change the structure of the show. I'm finding that it's a little more helpful, a little more easy for me to stick with some key themes and charts if I'm able to focus on the charts for this show. But I love the live Q&A and I love having interaction with you. I love seeing you guys ask questions and interact with each other and sort of mentor through a great conversation about tickers and charts and ideas. So we're going to do that as a separate thing tomorrow. I'm calling it Ticker Tantrum. It's tomorrow, Thursday, November 6th at 1 p.m. Eastern, 10 a.m. Pacific. You can find more info and sign up at marketmisbehavior.com/ticker. That is a free event. It will be a live Q&A. I'll have a couple charts queued up just to get the conversation started, and then we'll open it up to questions from the group. And so I would encourage you to attend. Bring a question with you. We'll keep it interactive, and will be a pleasure to compare notes with all of you and answer any and all of your questions. Again, find more info at marketmisbehavior.com/ticker. By the way, that's the same link you're going to use to watch the event. So add it to your calendar, November 6th, 1 p.m. Eastern, 10 a.m. Pacific. All right, daily chart of the S&P. Look at this. If you wonder why I talk about using the 21-day EMA, days like this remind me why it's such an awesome thing to do. Days like here, back at the end of September, days like this, first trading day in September, back here in mid-August. This is why the 21-day EMA has become something I've focused on quite a bit. If you want more about this, I've put YouTube videos out about the 21-day exponential moving average, and I also interviewed Mike Webster from Investors Business Daily. We talked about the 21-day EMA. We have similar ideas about the benefit of using the 21-day EMA as an initial stop. So I encourage you to check out those videos. I'll try to remember to post links to both of those, so you can check them. Out. So look for the description or the first comment. I'll try to remember to do that. I'm going to circle that like twice so I actually do it. So we did bounce off the 21-day EMA. We traded down to it yesterday. Pretty normal after a big downside move to have a nice kind of recovery day. Think of this as like the aftermath. This is the big Thanksgiving dinner. Then you need to like sit and let your belly settle down a bit. That's what today was. The question was, do we resume the downtrend through the remainder of this week? Is this just a one-day bounce, what we call a dead cat bounce, before we resume the downtrend? 21-day EMA, keep watching it. Also, we're going to watch the lower trend line. This is a trend channel formed by the major swing lows over the last 4 months. And the market has had a pretty nice kind of classic uptrend of higher highs and higher lows, which means that lower trend channel line is something to watch as well. For now, we're making higher lows. For now, we're holding the 21-day EMA. For now, the RSI is holding 50. If those three things that I just mentioned are no longer true, that is when I would say you have permission to be a lot less optimistic about the uptrend in stocks. Now, we've been covering warning signs like breadth, and I'm just going to highlight no real change in the percent of stocks above their 50-day moving average. We're up slightly to 41% at today's close. No real change. The percent of stocks above their 200-day, we're about where we were yesterday, around 55%. So short-term breadth, pretty negative here with the McClellan oscillator turning below zero. The percent of stocks above their 50-day going below 50. That actually happened a couple weeks ago, but sort of re-upped about a week ago in the last week in October. Those are not good signs. That tells you in the short term, we're seeing plenty of distribution. The long-term breadth is still good, just like the long-term trend in stocks. It's still okay until it isn't. We'll keep an eye on that chart for sure. Rates pushing higher pretty good today, right? So the TLT was down. Bond yields, particularly the longer end of the curve, 10-year, 30-year points were all up. Why is it important to watch interest rates? So I would say from a technical perspective, it's pretty positive for rates that the 10-year yield $TNX on stock charts got above its 50-day moving average. It's actually been below there since July. So from a technical perspective, I would say we're still for now in this downtrend channel, but we're pretty close to where this looks like a big upside reversal. We talked about that like back in April when we had been in a downtrend channel. We broke out and sort of continued a little further there, which coincided with the April market low. Now, besides the technical take on the 10-year Treasury yield, which I would say on the tactical time frame is certainly positive for yields, I would say breaking above 4.2% on the 10-year would be incredibly important. Because that would mean a break above that upper trend line channel, and that would also break above the swing high from September, right? So 4.2% is kind of the level. That's I just jotted down a note to remember an alert. So why are we focusing on rates going higher? Because certain sectors don't tend to do well when rates start going up, and if you'll notice, rates have been going down pretty consistently from May through mid-October. And so certain things have had a big tailwind that if rates start to really go higher, that could become a big headwind. So what are the types of stocks that have done well, arguably in some way because of lower rates? And could the other side of that coin struggle if rates start to go up? A couple things come to mind. First, you have the interest rate sensitive sectors, defensive sectors like utilities, real estate, telecom stocks. These tend to have a lot of debt. They tend to pay a higher yield. So higher rates for bonds mean their high yields don't tend to be as attractive. And so it tends to be a little worse for sectors like utilities and old school telecoms. Tends to be rough for consumer, retail names, right? Think of the consumer, it's getting more expensive to borrow money. So you're less likely to take on a bigger purchase because it's going to become more expensive to do so. Technology tends to do really well with lower rates, tends to struggle with higher rates because the value proposition of buying a big technology stock with growth prospects. Remember, sort of conventional wisdom is that the stock is worth the present value of its future cash flows. That's the dividend discount model, or some valuation metric that you may be familiar with if you went to business school or took an economics class. It's all about present valuing the future cash flows of this company. So future earnings are just less attractive because you use the interest rate, the 10-year yield, basically as one of the inputs to that model. So if the 10-year yield goes up, the future value is lower, and so they're worth less today. And so that means not as good for technology and other kind of high growth stocks. Housing, right? Because higher rates mean higher mortgage costs. So those sorts of things. So, and then the other one I would say would be small caps, industrials, stocks and companies and areas that are going to be borrowing a lot of money. Just like it's not good for the consumer, higher rates aren't good for big companies that have to borrow a lot of money too. So who is it good for? Banks, right? Steeper yield curve, higher long-term rates tends to be good for banks. That's kind of their business model, is borrowing at the short end and lending out at the higher end. So a steeper yield curve, lower short-term rates, higher long-term rates should be great for financials. I did happen to grab the chart of Bank of America so I could show you what everything I just said could translate in terms of the current technical configuration. But that's why rates going higher could be an issue for a lot of things that have been doing quite well since the April market low, particularly technology. That's a tough one. Now, high yield spreads widened out quite a bit. This is a data series from Bank of America called the High Yield Index Option Adjusted Spread. It's a one-day lag on stock charts, which is the source I use for this indicator. High yield spreads are basically credit spreads for junk bonds, for the bonds of risky companies. And so when high yield spreads widen, it means investors are getting nervous. Now, today, I would assume, given what we saw from the equity markets, that high yield spreads probably tightened up a bit. But yesterday was a big kind of explosion in high yield spreads. That widening in spreads, that increase in volatility could be a real issue. Both of these are probably coming in a bit today. But if they continue to expand, that would be a big danger sign for stocks as well. So I want to spend a moment highlighting on the chart of Ethereum. Great kind of masterclass, a case study in Fibonacci retracements. If you take the April low, which is around 1,400 for Ethereum, you take the August high, which was just below 5,000, 38.2% of the way down is right here at 3,600. That's pretty much where we pulled back into early October. We then bounced up to the 50-day moving average. This week, we are down testing the 200-day moving average. We closed below it yesterday. We're currently trading just back above it. But note how this week's low is lining up pretty well with the 50% retracement. If we stall out here, I wouldn't be surprised if 2750, which would be a 61.8% retracement of that full rally, could be the eventual downside target. That's what I would be keeping in mind. And same chart for Bitcoin, which we showed yesterday, would put a downside target around 93,000 on Bitcoin. It's currently just above 104, 105,000. So keep that in mind as potential downside targets if previous support does not hold. Here's the chart of Bitcoin bouncing off of 100,000. Big round number, as we mentioned, not surprising by my read. I think that's pretty common. But note that the correlations between Bitcoin and the US dollar are actually pretty non-existent, right? There's no real good relationship between Bitcoin and the US dollar for the last month. Same can be said, Bitcoin and the US dollar. Here's Bitcoin and the S&P 500 in the bottom panel on blue, also right around 0%. Of the last couple times, this correlation has gone to zero, was here in late February, here in mid-June, here in September. And of these last couple times when the correlation was very low, Bitcoin ended up rallying higher. Now, that's because stocks were in a primary uptrend and Bitcoin kind of pulled back. And so Bitcoin kind of resumed higher. But The other way that correlations can go back very positive is if Bitcoin remains weak and stocks start to weaken as well. So correlation does not imply direction. It just implies the relative relationship between two different things. In this case, Bitcoin and the S&P. So right now the relationship is pretty murky, not very consistent at times. There's a very strong positive relationship, and not right now. All right, a couple final charts here. We talked yesterday about, some of the market top signals we often look for would be a deterioration in the previous leadership, which means semiconductors, if you weren't watching them already, and I would imagine you are because they've been arguably the strongest, not even close area of the market, maybe besides gold at times, but semiconductors have done pretty well. We highlighted the SMH earlier this week. Just want to highlight today, Micron up another 9% after yesterday's pullback, making yet another new all-time high. As long as stocks like Micron are above an upward sloping 21-day EMA, which is above an upward sloping 50-day moving average, which is above an upward sloping 200-day moving average, and the RSI is consistently above 50, I don't think there's an issue right now with semiconductor leadership remaining quite strong. That's the trend I would observe right about now. Bank of America, by the way, I wanted to highlight, this is a good interest rate play. If you're concerned about rates going higher, one of the ways to play that is to invest in banks, because banks tend to do better the steeper the yield curve and the higher longer term rates get. You can go back in history and see perfect examples of that. Bank of America has had a number of pullbacks to just below the 50-day moving average in August and in October, and both of those resulted in a new 52-week high very, very soon after. We might be in another one of those pullback things. Bank of America was actually down 2% today. We'll see if it's able to find its footing, and keep an eye on the momentum as well. Those last two times, RSI got down to around 35 before we rotated higher. So see if we have a similar configuration to what we saw there. If we see buyers come in again, it could be another nice upswing for Bank of America. Finally, shout out to biotech. I haven't talked a lot about healthcare in today's episode, but I'm noting Amgen, one of the top performers in healthcare today, up almost 8% at the close. And that, I would argue, really confirms a rotation out of a symmetrical triangle pattern. Since the beginning of 2025, we've experienced lower highs and higher lows. We have now broken out above the upper trend line. We've now broken up above the October swing highs around 300 to 305, and now we are clearing the way to much further upside. The resistance level is right about where we're at, kind of 325, 330-ish. So if we can power above there, nice upswing. But the beginning of a big up move often is met with overbought conditions. That's what I'm seeing right now for Amgen. That'll do it for today, everyone. Thank you so much for joining me here on Chart This with Dave Keller. Thank you so much for following me and my work. I hope you find it helpful. I hope that it helps you make sense of things, gives you some ideas, gives you some context, and as always, a great opportunity to ask questions. Don't miss our ticker tantrum. That is our live Q&A. Will be tomorrow morning Pacific time at 10 a.m., 1 p.m. Eastern time. You can sign up and get all the confirm all the details at marketmisbehavior.com/ticker, TICKER. I'm Dave Keller with Market Misbehavior. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.